Are there any other questions, concerns, comments?
If you can't think of it right now, we'll give you a chance again at the end of tonight's presentation to ask us anything that comes to mind.
Absolutely. All right. So that's all for the announcements for now. Again, if you can, especially if you're a freshman or sophomore, I highly recommend you go to the QFC's resume review and also like let them know what type of field you're interested in, or if you're interested in a variety of fields, and they'll be able to help you out with that. So now I'll hand it off to John. John's going to present today's topic.
Yep. All right, just give me a second to get the slides up. All right. All right, everyone. Well, hello and welcome to today's presentations. Throughout our past meetings together, I've mentioned a few metrics related to an algorithm's performance. We're giving you an overview of what you guys are going to make and how to assess it. Today, I'm going to give you guys an in-depth explanation of a few important metrics so that you guys have an understanding of, how good is your algorithm doing, where can you improve, how specifically can you improve, etc. So on Quant Connect, once you've finished running your back test, you will get a little box at the bottom of your screen that gives you a whole slew of metrics related to your performance. There's more metrics there than you'll ever need. Like, they're going to give you a crap ton of statistics just listed out there that some are more important than others, to be completely honest with you. The real reason that you want to look at these numbers, these ratios that they give you, is because there's going to be certain aspects of your algorithm that you're going to want to know, more about. For example, how high did your algorithm actually return? You can basically assess, bare minimum, did we make money? Did we lose money, etc. Did the amount of money you return kind of justify the risk you took? There's actually a metric I'll go over that directly relates your algorithm's performance to the amount of risk in your portfolio. How much did your algorithm correlate with the market as a whole? Another question that's answered with a very basic statistic. So, as I said before, Quant Connect will automatically calculate all of these answers to all these questions, give you a whole bunch of metrics, which is very nice because the actual calculation for these things is god awful. So I listed over here just a few of the metrics which we're going to be going over tonight that, in my opinion, are going to be the most important. For starters, we have the percent return of your algorithm. This is, as I wrote here, the rawest metric, because all it shows is, all right, what's the current value of our portfolio? Where did we start from? So how much did we grow? Straight up, like if your portfolio went from 100 grand to 120 grand over a year, 20% return. It gives you, just a bare minimum, did we make money? That's about as much as it can tell you. If you want to dig a little bit deeper and see, okay, how did our algorithm really perform? Like, it's great we made money, but what else can we glean from our performance? Well, then you'll start looking at a few other metrics. The first, and one of the most important, is your beta. So the beta metric basically outputs a ratio that tells you how correlated your portfolio's returns were with the overall market. A little side note, if you guys look at the returns of a lot of hedge funds, you'll notice that most of them underperform the S&P 500. So, it's a big question. How do these hedge funds still exist? What's the point of it? The reason is that these hedge funds' returns usually are very uncorrelated with the S&P 500. As we all know and have seen, especially in the last few years, the market as a whole can be wild, volatile, and at times very unpredictable. And if you're rich and you're trying to keep your money safe, putting it just straight up in the S&P 500 might mean you lose 30% even in a single year. We've seen some pretty wild turns during the pandemic. So one goal for a lot of quant algorithms is to minimize your beta and get it as low as possible. If you can make sure that your returns are not really are not really, coming from just the market itself, that gives you a huge advantage because then your portfolio will be able to generate returns in excess of the general market. Guhan, you want to hop in here?
Yeah, just to understand how beta is applied, a beta of 1 means that you are symmetrical with the market. That is, you're not any riskier or any less risky than the market is. So I could park, if I'm parking my money in a stock and it has a beta of 1, then it's equivalent to putting it at the S&P 500 in terms of risk level. A beta of less than 1 means that it's less risky than the S&P 500. An example of these type of stocks are going to be the big in blue chip stocks are usually less than 1.0, and so insurance companies invest in them a lot because it's almost a guaranteed return, but it's not as risky as S&P 500. And then a beta of greater than 1.0 is more risky than the S&P 500 as an investment. So usually tech stocks have really high betas because, as you know, they swing. If anyone's been watching like Tesla, yesterday they shot up 12%. Like 6 months ago, they were $400 less than where they are right now. So it's kind of insane. They have a huge beta. So you want to look at this. It's not we're not going to say, oh, if you have a high beta, we're going to give you more points. It's not like that. We're going to look at all the factors, but you want to understand that, you want to understand the strategy you're choosing and how beta is going to play into that strategy.
Yeah.
Did everyone get that? Does anyone? Yeah, sorry.
Yeah, so actually an algorithm I'll show you guys on the next slide, once my computer starts complying, is actually going to show you, how do you find beta and how does it relate to overall performance. So if you look at this metric called alpha, an easy way to think about alpha is it is the excess returns from your portfolio after accounting for how much the broad market affected your returns. It's kind of a big, about a large way of phrasing of it. So what it boils down to is some of your portfolio's returns would just be, okay, how much did the stock move with the market? The S&P 500 is on an uptrend. It's going up, day after day after day. Your stock is going to be carried with it in the current. So one thing that a lot of funds, a lot of quant traders really want to just maximize is this alpha. Alpha is, as some people like to put it, kind of like a pure return. It's the amount that your portfolio's value increases after accounting for the market itself. So if the market had like a terrible year, the S&P 500 crashed 20%, but you have a low beta and a high alpha, well, you're still going to be making a good bit of money and your client's money is going to be safe. In the hedge fund example, for your algorithm itself, you're not going to lose a lot of money, which is always pretty nice thing in general. So there is this model, I believe it's called CAPM, that basically relates beta and alpha to your algorithm's return. So the total return of your portfolio in whatever time period is broken down into your beta metric multiplied by the return of a benchmark, normally the S&P 500 minus the risk-free rate. I'll go over that in a second, plus alpha. So quickly digressing into this benchmark return minus risk-free rate. This quote unquote risk-free rate is kind of a standard for any kind of assessment of a portfolio. It says, basically boils down to if you were to just put all of your money into the safest asset, usually it's I think 3-month treasury security, not exactly sure. But so it's basically like if you were to put your investment in a quote zero risk vehicle, which of course is not real, there are no real zero risk vehicles, but once we can get to it, how much money would you make? Usually the value you would put into this formula is the current return, the current rate for treasury security. So it's going to be relatively low. So let's say your algorithm returned 20% with a beta of 1, or not even, or a beta of 1, and your benchmark returned, I don't know, 12%, risk-free rate's 1%. That means that basically 11% of your return was correlated with the market, and your alpha is the other 9%. pretty solid amount if you have that high of an alpha. So the overall goal of your portfolio will be to make your alpha as large as possible and your beta as small as possible. This way, you don't have to worry so much about the market's wild swings. You can just focus on making money itself. Another extremely important return metric is the Sharpe ratio. The Sharpe ratio basically gives you a numerical value that relates your portfolio's return to the risk that was taken on. So the way that it calculates this metric is it looks at, okay, how much on average did your portfolio return over whatever period? Exact math's a little difficult, and then it divides it by your portfolio's standard deviation. The standard deviation of your portfolio is, what's the average kind of, well, I'm sure most of you know what standard deviation is. It's on average how far away are your values from your mean. And so this metric will say, okay, if you have a higher portfolio standard deviation, obviously that means you have a much risk, you're taking on more risk because there's more variability in your returns. So if you look at, how much your returns actually were, how high your mean value was, if you will, how much bigger is it than the standard deviation? A goal for every algorithm is at least hit 1. Because if your Sharpe ratio is less than 1, that means you're taking on a risk that is pretty much out of proportion with the rewards you get. You're not making the most out of your trades. You're taking on too much risk. You're not getting enough out of it. If you have a higher Sharpe ratio, like above 2, I mean, that's always an awesome sign. It means that for whatever amount of risk you're taking on, you're making more than enough to justify your actions. So of course, the higher the Sharpe, never going to hurt you. The next metric, which in my opinion doesn't matter at all, but kind of depends, because it really depends on how your algorithm is built, is your win rate. So theoretically, if you win only 10% of your trades, but you make 3% on each trade, and you lose 90% and only lose like 0.2%, you're going to be making money. One of the most important things to consider with your win rate is that, okay, you win X% of your trades, but how much money do you make in those wins and how much money do you lose in those losses? If you cut your losses short and let your winner win, you're going to make a lot of money. Those of you who are familiar with Renaissance technologies, one of the most successful hedge funds of all time, probably the most successful quant fund of all time. Average returns since its inception, like 30 plus years ago, are, I want to say around, after fees, like 40 to 50%, which is unheard of. A large rumor, which has been substantiated in some contexts, is that they only win about 50% of their trades. But because they cut their losses short and they let their winners run, that translates into absolutely insane returns. So yes, your win rate will tell you how many trades you make money on, but at the end of the day, it's more important that you practice good money management so that you limit your losses and maximize your wins. All right, the last metric that I'm going to go over is the drawdown. The drawdown is, simply put, the lowest level your algorithm hit. So if your drawdown is pretty large, like a 60%, that means that you had a moment during your back test where things were pretty damn scary and it looked like your portfolio was about to be wiped out. On the other hand, if your maximum drawdown was 10%, that's really solid. It means you didn't have one of those periods where things got really, really bad. This kind of, again, relates into the idea of you want to keep your money safe. The number one goal of investing, according to Warren Buffett, is don't lose money. The second rule is don't forget rule number 1. Drawdown tells you just how much money you have lost at a particular moment. So if your maximum drawdown is higher, meaning that instead of like a 30% drawdown, it was like a 10%, that's always better. You want to make sure that your algorithm never went so down under that realistically you probably would have put it out of commission if it were live. So that is about it for the metrics I have to go over. Now we'll open the floor to any questions you guys have, either about this presentation I just gave you or about your upcoming presentation on Thursday.
Hey, a quick question I have. I appreciate the presentation. In terms of our for the presentation on Thursday, I'm assuming this is a slide deck, and I was just wondering how many slides do you expect and how much time are we given to present?
So
Really have like
the
a
number of
minimum-
slides, it's probably gonna be three to four. It really shouldn't be that too much longer than that. Amount of time, 5 minutes. It really shouldn't be longer than that either, since we're just asking for an outline and a sketch.
We want you to be short, sweet, and to the point. Tell us what we need to know and, yeah, cut it at that.
Perfect, thank you.
Yeah. Do we have any more questions? Did everyone understand what John presented today?
I have a question.
Yeah.
Can you go over the beta again? I thought the beta is just a measure of the stock volatility in relation to like overall market.
Yes.
that-
Yeah.
But I'm not sure how that is related to our algorithm and stuff.
Well, beta
So-
can be applied not just to a stock, but to an entire portfolio of securities. So over time, your algorithm will be investing in, a whole array of securities depending on what you set. So you could kind of treat your algorithm's investments as a portfolio that's always changing. And so you find the the beta of this portfolio. So it measures your portfolio's kind of relation and exposure to the broad market as a whole.
Okay, so we use beta in this case. We use it to measure the return of our portfolio rather than the price of stocks, right?
Yeah.
Yeah, because I was thinking that, and also like there's another question about like the major difference between like the volatility and the momentum.
Major difference between volatility momentum.
Yeah.
Okay. Yeah. That's actually a really good question. So, I mean, if you're just thinking about them, volatility is, how wildly you can change. Momentum is how it's running. They can sound very similar. Here is the number one distinction between the two. Momentum is shorter term and temporary. Momentum is just at this current moment. Where are we moving and how quickly are we moving? So how strong is our current trend? Volatility, on the other hand, is more of a long-term metric. So like over the past 4 years, if you look at a stock like Tesla, that has had wild swings upwards, downwards, consistently has been in a rather erratic state in terms of the security's price. So that is definitely something that's volatile. On the other hand, if you were to look at a more stable, established company, like let's say US Steel Corporation, if you looked at their stock price, it's not going to move as wildly in the short run. And that means you could say it's a less volatile security. So it's possible that at one point Tesla is, kind of moving in a bit more of a channel and is having a bit more contained returns. So at the moment, the momentum might not be as strong, but over the long run, it will have these wild and erratic movements. So it is very volatile.
Okay, so when we measure the volatility, we tend to look at the price of stock in the long term. We want to see if the price of stock swings. But when we look for momentum, like we tend to look at like each point. Like by point, I mean like maybe a few days or something. If there's a sharp going down or going upwards.
Yeah,
So,
exactly.
Okay, I see. Thank you.
We have 2 questions in the chat. Where can we find these recordings and slides? They're in Discord. Yeah, we'll see if we can start like a drive as well, but for now, Discord's going to be the easiest way to access them. And then the next question we have is, what's liquidity? Good question. I don't think it directly plays into the companies that you're going to be investing in. Maybe it'll play into your portfolio, but I'll explain what it is. Liquidity is the access to cash and how easily you can get like physical or even money in the bank, really. But so assets that are liquid in nature, you can easily transfer you can easily switch into cash. By easily, I mean like overnight type of thing. So examples of that are going to be like stocks, which are really easy to change into because you just sell the stock and then you have cash in hand. Now, other things, the stuff like machinery or like if you own a building, something like that, those are illiquid assets because it takes time to sell them. So if you had to cash out tonight, it's going to be really difficult to get rid of those assets. Does that help you? Does that answer your question? Sure. We had another question in the chat. Do we need to talk about alpha, beta, sharp on Thursday? Not this coming Thursday. We will expect it once you start writing code. That will be next week, not this week.
Yeah, once you actually can run a back test, we'll want to know what your alpha, beta, etc. were, but don't worry about it this week at all.
Yep. Do we have any more questions?
Oh yeah.
And it can
so
be, yeah.
Go ahead.
Yeah. So in a general case, like when you trade, when you use momentum trading strategy, how do you hedge it? Because I know that for pairs trading, you want to take the long position on one stock and short position on the other one, to hedge the risk. But I wonder, like, how do you hedge in momentum trading?
That can have a very complicated answer. To be completely honest with you, there are a lot of routes you can take. For example, one thing that immediately comes to mind, if you're momentum trading, you identify a stock that has, high momentum at the current moment. And let's say right now it's going up a lot very quickly and you're going to buy into a long position. One thing you can definitely do is set a stop loss order so that you say, okay, if the stock drops X amount,
10%, yeah,
10%, whatever amount you want to say, it's just gonna, you're selling position immediately.
Okay.
No, there are definitely other approaches you can take, like shorting other securities, a whole bunch of, you can get very complicated with this. It really depends on what specific approach you're taking in your momentum trade. And once you define, okay, this is the route we're going, you'll definitely be able to Google online and find some answers from people who have similar strategies and have an established approach for hedging.
Okay, so in momentum trading, like essentially you're just setting some limit. Once you hit the limit, like you either sell or buy. Whereas like in like pairs trading, you buy two stocks to hedge the risk.
Yes, for pairs, you're buying two, which will hedge your risk. For momentum, you're identifying a factor that is trending. And then once it starts trending either upward or downward, you can place a bet that it's going to go even higher.
I see.
Yeah. Do we have any other questions?
I just have a quick last question. So the strategies we're choosing, are those based off the last meeting we had last week on what you were teaching us about? Are those the only ones we can choose from? Or
I think you want it all. If you find that it interests you, if you think you can make a legitimate strategy, go for it.
Yeah, it doesn't have to be from what we showed last week. We just did that as an introduction, since it may be difficult to know where to get started. Yeah.
So we can basically start our own unique strategy, like just something that it could be unique. It doesn't have to be something from Google.
Yeah, absolutely.
Oh,
make sure it works. That's all.
Yeah. How would we go about testing our strategy?
Once you code it out, you can back test on Quant Connect. It'll give you an input date, and then you can choose which asset you're testing it on as well.
Yeah, that's all. Like the whole setting up the universe for dates, assets, etc., is in the Quant Connect video. So for all future presentations where you have code, click the back test button, it'll give you all your metrics after some time.
Thank you.
No problem.
I had a question real quick.
Yeah.
So for the strategy, are we, for example, if we choose to go for a pair trading strategy, do we have to find the stocks that we think are cointegrate, or just say that we're using the strategy for our presentation tomorrow?
For Thursday?
Yeah.
You can just say that's actually a good question. We didn't discuss this.
So the actual task of finding cointegrate securities is going to involve some coding. It will be a little bit more mathematically involved. So you don't have to say which securities you're going to use yet. You can just say we're going to pairs trade and here's an overview of how we want to do it.
Do we have to mention like any sectors or just say that this is our strategy and that's it?
If you want to, you can. We're not going to hold it, and we're not going to be like 3 weeks later. We're not going to say, oh, this is what you said the first week. Why'd you change? That's not going to happen. But if you do the research and you want to ask for feedback based on that, then definitely tell us what you're planning, even down to the companies, and we could look into it.
All right, thank you.
Yeah.
I'm going to stop the recording real quick.